Welcome back. Today we are going to be thinking with charts in which we go over quite a few infographic pieces of information that are abstract representations to help you conceptualize an idea and really get into how they're misinterpreted and how you can fall for the propaganda and disinformation if you're both so inclined through confirmation bias, but also if you don't know any better. So hopefully this will be an educational lesson and a demonstration for you to point to and understand and maybe gather some things. And if not, maybe it can be some entertaining. As the British economist said, if you torture the data long enough, it will confess. So I'm going to try to speed these things up because as far as I'm concerned, they're lasting 30 plus minutes and that's an awfully long time. Try my best, see what happens. With that said, week's performance, as always, I bought a new company, Tech Resources, and everything else is playing out. Centrus Energy is a fantastically volatile stock that I've been up, I think now twice 10+%, and here we are again in the red, so see what happens. Catching up on the loss in the uranium position, and Kinross is a slight win, so let's get into this. So what you're going to find here is a bunch of pictures, and I've copied some tweets. Lynn Alden, if you don't follow her, you should. If you don't listen to her podcasts that she's a guest on, you probably should. She knows a lot, very intelligent, smart thinker. And with that, let's get into it. So this was floating around a couple of weeks ago, this chart showing the consumer loans and credit cards. And so U.S. credit card debt reached a new high of $930 billion. I see this stat popping up on my feed a lot lately. So remember, you always have to keep constant your comparisons and control them to other variables. So the first chart we'll go back to look at, all-time high. Plain and simple, all-time high. So if you're the doom and gloom, doom porn fantasy kind of person who's paranoid and always looking for a crash, or you're a weak hand, this is really important for a lot of these graphs. If you're a weak hand, it underpins the significance of having conviction in the positions that you're in and the companies that you're invested in. Because something like this might shake you out. Oh no, this isn't sustainable. Last time it was an all-time high, it fell, so on and so forth. So you have to keep that in mind. Anytime you see a chart, whether it confirms or disconfirms your bias, you have to generally, know a general set of ways that charts get manipulated. So credit card debt as a percentage of GDP, roughly 26 trillion, is about 3.5%, which is below the average for the 2010s decade. Also, credit card debt as a percentage of total household assets, roughly $153 trillion, is about 0.6%, which is also below the average of 2010 decades. So now we're comparing credit card debt outstanding relative to other variables. So one of the replies was, good point. Interestingly, if we combine credit card loans with the fact that rates are at generational highs, the current rate-adjusted consumer stack looks like a wild dislocation and hits at a sharp reversion to the mean. So here your emotions are, perhaps, if you're that type of trader, which you shouldn't be, getting tugged before. You first see the outstanding credit card all-time high, so then that makes you fearful, and then you read a Lynn Alden contextualization comment to help soothe your anxiety, but then you see a rebuttal chart contextualizing it differently, and then maybe you get panicky again. So here Lynn Alden also offered more contextualization and insight, and said would be nice to see the result of dividing that chart by disposable personal income. Because credit card loan in the absolute sense doesn't matter, because it matters relative to disposable income and other such things. So this is a multifactorial equation in a complex dynamic system, and you're trying to incorporate as many variables as possible to help contextualize things the best that you can to, not screw up. So he provides that chart on the left hand of the screen. Here is consumer credit as percentage of disposable, DPI, disposable personal income, indexed to 1995, which in and of itself you should be concerned about, because later on in this video, we're going to get into why what it's indexed to at the beginning, timeline on the x-axis, is important. But I'm not trying to throw shade at him for providing this to 95, but it's always worth considering. Here's a consumer credit as a percentage of DPI indexed to 1995. But if you look at the chart on the left, yes, the rate of change has accelerated to an uncomfortable extent, you could say, and maybe even an unprecedented occurrence, at least back to 1995, as to the rate of change. But on an absolute level, it's below, or just is now peaking into what would have been the low end of the spectrum between 1995 and roughly 2008, 2009. So now it doesn't look so bad. The chart on the right was the initial one. You're like, oh my God, that doesn't look good at all. You look on the left, contextualizing it to disposable income, and it doesn't look near as bad. There's less fear-mongering, there's less panic, there's less concern, and there's a more thorough, comprehensive, integrative understanding. Okay, let's move on to the next one. The 2000, I've seen many comments like this, and we're not. So the 2022 decline did nothing but remove the most extreme froth from the valuations. To expect an extended market advance from here is essentially to view the area in the red box as the new normal and to dispense all of the market history before late 2020. Now, you always have to ask yourself, by the way, when someone's providing you with a chart or even a set of charts, you have to ask yourself, what are they trying to tell me by presenting me with this infographic? What am I supposed to infer from the infographic that they presented? And what sort of selection bias, conscious or not, went into that of their presentation? And normally it's always this doom porn type garbage. And it's garbage because it doesn't accurately reflect reality. And that's the multivariate nature of reality. So the rebuttal by Been There, Done That Capital at Been There Cap, definitely worth a follow on Twitter, is he says, it's misleading if taken literally. Today's businesses have structurally higher margins and should have higher price to sales, and weighted average cost of capital is permanently lower. Now, whether you agree or disagree with that, you could say that's speculation, but it is a fact that margins are higher. And he provides a picture of more with less. Workers needed at S&P 500 companies to generate $1 million in revenue. In 1990, it was 7. In where we're at now, 2023, it's 2. Now, imagine if you paid an employee $50,000 a year. You needed 7 of them. Now you need 2 of them. Now, one of the reasons this is the case is because we're shifting more to service-based companies and software-based companies in which you don't need, they're not as human labor intensive. You don't need as many people. You can do more with less. And by more, I mean generate more revenue. And so if you need 5 less employees from back then that's $250,000 per $1 million of revenue generated. So just imagine these companies are generating billions of dollars. How much actual money that is, quote unquote, being saved, even though some of that money might have to go into research and development and technology and so on and so forth. So it's not keeping constant comparisons and controlling for variables entirely, but it is adding another shade of color to the dynamic at play. So here we have this. Microsoft still has a higher market cap than the entire energy sector in the S&P 500. Keep in mind, Exxon alone produces just as much annual free cash flow as Microsoft today. And no, this is not just a specific case with Exxon. All the energy companies in the S&P 500 are profitable on a free cash flow basis today. Either tech companies are still too expensive, or energy stocks remain a bargain, or both. Now, I understand people aren't writing books in a tweet, and fair enough, but But there's a lot wrong here. And I do appreciate how he said, or both. And you have to stop thinking in terms of false dichotomies, because most people who would have written this would not have written both. They would have given you a either or ultimatum. And so you can't think in false dichotomies. And then you have to ask, why is free cash flow the metric? And how does it fare under other metrics? And you have to question the concepts in the statement as much as the statement itself, which you're going to hear me say a lot. Yes, it's a true statement, but is the conclusion that you're going to derive from this bar graph on the right-hand side reflective of the information? And the answer is, it's not telling you anything. What is this bar graph telling you? All this chart tells you is that a stock, that stock being Microsoft, at a particular point in time is larger in market cap than a combination of 23 other stocks of a particular sector within this S&P 500, also in a particular time frame. But people are quick to make these hasty generalizations and jump to conclusions. So, what might attribute to Microsoft being this way and having such a large market cap? So, the missing piece, the comment made, is the missing piece here is growth. Now, I would like to say to that, a missing piece, not the missing piece. Life, including investing, is multifactorial. Capital intensity and higher margins are also contributing variables in pieces of the equation. Because growth doesn't necessitate higher margins. Just ask the cannabis industry about that. So, Microsoft is up 7x in 20 years. Exxon is flat for 20 years and down compared to 10 years ago. So on the left-hand side, you look at Microsoft's annual revenue worldwide from fiscal year 2002 to 2022. And they've driven steadily, which might be, people like steady earnings and development, so they might be willing to afford it more of a higher multiple for the stock. And it's easier to model, so there's predictable and there's stability, so that gets a higher multiple put on the stock, in part. But also, they've done really well. While Exxon, or a lot of energy stocks in general, fluctuate with wild variations. So, and that's why taking that graph in a specific time matters. So, it's been a good time for oil, let's say, in the last year or two. So, therefore, in this time frame, but maybe you compare it to a different time frame and you get different results. So all of this has to be taken into consideration. And more likely than not, you could say Microsoft's a little overvalued and that the oil stocks are massively overvalued and they're overvalued or undervalued, and they're undervalued for numerous reasons. And yet again, you develop a comprehensive thesis and better understanding of all of this. And this is the point of dialogical conversations, is to engage with one another so other people check your thinking. Here's another one. Here's a poll Meb Faber did. Yet again, excellent man. He has his own podcast. You should listen to it. He has a lot of smart guests on, and he's a smart man himself. The disparity and discontinuity between speech and action. To know better is not enough, for you must do better. And that's in part what wisdom is. Wisdom is being intelligent and then actually acting on it. Because, for instance, anyone older than 5 knows not to lie or steal, and yet the world has tens of millions of adults who lie and steal. So here he has a poll. Do you think you're a better investor than Warren Buffett? 85% of the people say no. Then a question is, do you own Berkshire stock or replicate Buffett's stock picks? And then 67% of people say no. Now, the first poll had 2,000 votes, second poll had 1,200 votes. But even with all of this taken into consideration, the thing is if you don't think you're a better investor than Warren Buffett, then by default, you should invest, well, if you presume that there's 100% correlation that Berkshire Hathaway reflects Warren Buffett's investing, because he could provide higher returns if he had a smaller business, as he said, because it's easier to make higher returns with smaller sums of money than higher returns or larger sums of money. So, but to distill all this down is to say, if you don't think you're a better investor than Warren Buffett, then you should invest in Warren Buffett. And then people will say, I don't need to worry about any of this because I invest in the S&P 500 and don't concern myself with these matters. But that's just it, is that so you invested in the S&P 500 instead of investing in Buffett, which is to say the premise and presupposition that's embedded in that is that you think the S&P 500 will outperform Warren Buffett, or that you will be able to stomach an investment in the S&P 500 over Warren Buffett. But people think that they will have better returns in the S&P 500 generally than investing it in Berkshire Hathaway. That is the takeaway, which is to say that they actually do think that they're a better investor than Warren Buffett, because we're all active investors, whether that's the bank account you choose, the interest-bearing savings account you choose, the money market account you choose, how you do a bond stock split and risk parity in your 401k, or however you invest in an active trader brokerage account. You're an active investor. There's not being an active investor. You give a hedge fund money, you're an active investor. You're betting on a jockey. Same thing here. And just because the status quo and default is to invest in a 401k and have that be the S&P 500, all you're doing is trying to abdicate responsibility and culpability for your decisions. You chose to do that, which means that you chose to be an investor, which means that you chose to conduct yourself in a fashion that would be better than other options because you're a rational agent. And I mean, if you don't get that, I don't know what to tell you. So now we're done with the tweets, and here is a beautiful chart from the Office for National Statistics, which is quite alarming. So on the graph on the left, you have an update on January inflation statistics, and the graph shows 4 months, October 2022 up to January 2023. And on the left-hand side, what you'll notice on the y-axis, the vertical axis, is that the graph starts at 8%, and then it goes to 12%. And the point of this, the point of the infographic, is to try to tell you something in a misrepresentative fashion, because that's how most graphs often are presented. They're trying to trick you. They're trying to indoctrinate you with whatever propaganda that they're interested in you absorbing and thinking. They're trying to influence your thinking. And it's like, wow, you know, that bar graph is really dropping pretty nicely. Because that's what people do with graphs. They give it a quick glance, and then it confirms or disconfirms their bias, and then, depending upon that, determines how they dig deeper into it. So people are going to look at this graph, they see inflation, they see the bar dropping nicely, and then they move on. And then on the right side, you see the same bar chart, except it's pegged on the y-axis to 0%. And look at that much more gradual, slight change in the symbolic representation of the imagery. And, well, it doesn't look so impressive in case you're trying to get reelected or something and trying to demonstrate and give a quick glance to people as to how you're helping with inflation. Here's another example. In early 2019, Fortune magazine published a piece on the detriment of cable cutting and how that was hurting companies. So there is actionable relevancy to all of this I'm saying. And maybe you have a cable company and you're getting a decent dividend, and you're like, okay, well, the dividend will cover down times and it'll help me with staying power and not give me such paper hands. And then you see a chart like this and you're like, oh my God, you know, this is worse than I thought. I need to get out. This is not good. My fears have come true. But then if you take that same graph and actually in an intellectually honest and genuine way represent it, which would be the graph on the right, you see that it's not nearly as dramatic. It's not nearly as prompting you to manufacture indignation and get an emotional rise out of it, which is what most of media is. and I guess even this video is it's a call to action and to prompt you to not be stupid and to be more intelligent and a better custodian and manager of your capital and just of you as a general citizen and participant of the world, and to not be ignorant and to not be as susceptible to manipulation and distortion of reality, and to demonstrate how easily it can be done if you're unaware of the ease in which it can be done and the mechanisms in which it is done, such as starting a chart off at some number and then going up to another number. You have to question the concept embedded in the chart, which is, why did we start at 78% and stop at 83%? Here's another example. This was around the Brexit time. The pound falls as Parliament rejects an amendment that could have led to a delayed Brexit. So you have to ask yourself, is the person presenting this chart want me to vote for or against Brexit? And look at this, the pound against the dollar. Like, wow, that's scary stuff. But here's the same movement, but on a larger time scale. Instead of a, let's call this a 20-hour time scale, you look at it on a 2-year time scale. And that's what happens. And this is important to do on a stock you're holding that drops 10% one day. And maybe next week we'll get into how pretty much most of the offshore oil sector sold off hard in the last week due to the earnings calls, and then has subsequently rebounded, and many of them practically making up all of their losses, or in the case of Tidewater, reaching all-time highs. And so you have to zoom out. You have to contextualize it on different time frames and magnitudes of move to get a better understanding. So that's not such an alarmist chart now, is it? So some more misrepresentations. Selection bias, constraining the data set. Most of the time when people present information, the information they're saying actually is factually correct. The majority of the charts I've shown you today have been factually, the information embedded in the graph are all facts. This chart is all facts. But the interpretation that you walk away from is more likely not going to be a fact, because they don't actually expect you to critically analyze anything. So total confirmed COVID-19 deaths per million people. What they're trying to demonstrate to you with this graph is how Sweden's irresponsible behavior is causing unnecessary deaths, and therefore don't be like Sweden and instead do a bunch of dumb shit instead. And like, don't use Sweden and, well, look at Sweden, they're doing fine, they're not doing lockdowns near as intensely as we are. And then, someone pulls out this graph and says, yeah, but look at how many more are dying. Okay, and don't get too ahead of yourself, manufacturing indignation, because the next chart is, now look at Sweden at the very bottom. Now what happened? How did Sweden go from this at the top near 200 to down here at around 200? But this chart says, hey, Sweden's horrible. And then this chart says, wow, Sweden's amazing. Well, it's selection bias. The subjective emotionalist likes to constrain the data set to comparisons that make them look good. It's the whole I'm good by default because you're bad. And so therefore you find someone beneath you to compare yourself to feel better about yourself, which is why a lot of people talk crap on other people all the time, is because they need to find some low-hanging fruit to contrast themselves to, and then by default be better than, because they don't actually want to put in the work to actually be better. So if you compare Sweden to these other countries, then Sweden's doing fantastic. which is why often you want a more holistic, comprehensive analysis. But you're like, well, 1, 2, 3, 4, 5, 6 data points, like, isn't that sufficient? Well, sometimes and sometimes not. And you might say, well, you're just a conspiracy theorist and, anti-vaxxer and blah, blah, blah. Okay, fine, whatever. Like, for sake of argument, let's not address that or dignify that with a comment. But if you cannot distinguish between the covert manipulation embedded in all these charts I've been showing, including these COVID ones, but because COVID ones, depending upon your predilection, if you're an anti-masker, as they say, then you're going to like the second chart. If you're a pro-masker, then you're going to like the first chart. But the fact of the matter is both charts are intellectually dishonest and disingenuous and misrepresenting, and they only serve you and your confirmation bias. Both charts, on the absolute sense, are wrong because they're misleading and misrepresentative of reality, because reality is all the countries, not some countries, not a small handful of countries. Well, same thing here. Per capita CO2 emissions. Look at China and India, just such disastrous perpetrators and malevolent predators of the ecosystem and natural world with all their carbon emissions. And look how great Japan, Germany, UK, and the United States have unified and care about the environment. But notice how the chart goes to 1990. Well, that's interesting, isn't it? And then we go and look at this chart that goes back to 1960. And what you see, so this chart, the first chart, this is relative. This is relative. And then this chart is absolute. So we have one that's a relative CO2 emission per capita, and then we have one of absolute CO2 emission per capita. And that makes a big difference. And they're both actually relevant and pertinent, depending upon what you're trying to figure out. And what you find out, 1960 to now, India's been going up, China's been going up, but the United States the primary trend has been down, and the United Kingdom's trend has practically been flat or down. And that's interesting because I'll put a link at the end of the video to the video I made about why I'm bullish on natural resources, including, that was in particular relation to coal, but in that video I talked about the S wealth curve and how China hit the S wealth curve in the late 90s, early 2000s, and how it inflected and how that non-linearly and disproportionately puts demand on resources and all resources, and how India is now getting to that point, and how the United States, so let's get to the next chart, our final chart. So on this chart, it's more comprehensive. Australia, United States, Japan, Germany, and Europe still all produce more CO2 emissions than big evil China and India. And what the first chart I showed you was trying to demonstrate was pretty much the whole decarbonization and deindustrialization of India and China, because we have to save the world. And look how good we are. It's not us the bad actors, it's you all the bad actors. Just look at your ramping line chart. And if you look at this chart, so there's a few interesting things here. Number one, India and China are pretty much at the equivalent of 1900 or earlier levels of CO2 emission. Like, that should be pretty mind-blowing to you, that we as United States were producing more CO2 emissions than either China or India currently is. And then I talked about the S-curve, and then you'll note about, I said around the 60s or 70s, somewhere in there, can't remember exactly, that the United States started flattening off. And then you'll see that we peaked in about 1970, and we've been going down. But some of that is efficiency, not necessarily consumption of oil and or coal, even though coal consumption's down, but oil is not. And so there's a lot more variables that go into this. But with that said, just keep in mind these things, and let me know in the comments section if you like this or if you don't like this. Or I really like this, and I'd like to do a few more of these because I think it's absolutely fascinating, the extent, and people aren't oftentimes doing this intentionally. You have the top players, the propagandists that do this. They're disinformationists. But then you have the people beneath them, the sycophants that will promote that, knowing better. And then beneath that, you have a bunch of useful idiots and true believers that will just mimic and regurgitate it on either side. Doesn't matter. This isn't a political, well, this isn't a particular political affiliation disparaging video. This is disparaging on both of them. And so that's, you know, good old equality for you. And it's beyond that. It's about the human propensity and disposition to look at a chart and not take it seriously and then walk away with it based upon whether it confirms or disconfirms what it is that you already wanted to believe. And to know that these are innocent enough mistakes a lot of times. You present a chart. I've done it myself. And I'd like to finish a story with a quick story, which is the Kansas City Star years ago published a piece because they were considering about banning peanuts in their baseball stadium. And on the front page of the Star, it said over 1 million Americans are allergic to peanuts. And that's a big number. It's like, wow. So that would be an absolutist number. And I thought to myself, because even back then I was like, I just know how people like to manipulate things all the time. And I was like, and one way to figure it out is to say something differently and see if that has the same emotional impact on you than the alternative consideration. So I thought to myself, I'm like, 1 million people, like how many is that? And I was like, oh, I'm like, that's less than 1%. And I was like, you know, if there's 350 million Americans, 1 million, so we're talking like less than 1/2 of 1%. I'm like, well, why didn't it say less than 1% of Americans are allergic to peanuts? No, it didn't say that. But both statements are true. They're both facts. Both 1 million, over 1 million people are allergic to peanuts. That's true. That's a fact. But this is the whole problem of deriving an ought from an is. And this is where people go wrong. It's not that the facts they present aren't true. It's that it's at the cost of other facts that would either contradict their facts that they put forth or would help further contextualize it to diminish the magnitude and the severity of the facts they put forth. And that's extremely important to take into consideration. So they could have just as well said less than 1% of Americans are allergic to peanuts. So it only stands to reason for me that they were trying to prompt me or whatever citizens of that city to vote for banning peanuts and or having a peanut-free section in the stand. And I honestly don't know if that publication is more liberal or more conservative, so I don't know. But with that said, I'm going to end here. Thank you for watching and listening, and have a good day or night, and until next time.